Hi everyone, today we'll be going over accounts, May-June 2021, paper 3-2, question number 4. This is structure paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 4 is a part of section A, which deals with financial accounting. Now, without any further delay, let's get started. G Limited has prepared the draft financial statements which are to be audited. And the draft statement of financial position at 31st December 2020 is as follows. Okay, and we are given following information. Let's have a look at our first question. We need to state 3 features of financial statements which show a true and fair view of the company. So the very first one is that the financial statements should be factually correct in order to show a true and fair view, right? Let's write it down. So the first one is it should be factually correct. Then the second one should be that those financial statements need to be prepared in accordance with the accounting standards and the legislation of that particular country, because if that's not the case, then it might not show a true and fair view of that particular company. Let's write it down. Prepared in accordance with accounting standards and legislation. And the third feature would be that those financial statements should be free from any bias. Let's write it down. Free from bias. Alright, this concludes the first part of this question. Now we can move towards the second one. We need to explain to the directors the appropriate accounting treatments for information items 1I, 1II, and 2. And we need to do so by making reference to the relevant international accounting standards. So let's have a look at the information item 1I. Okay, so we are told that goodwill is comprised of 2 elements. And the first one, on 1st January 2020, G Limited acquired a partnership business and the goodwill valued at 30,000 was recorded. The value of goodwill at 31st December 2020 should be 24,000. So this is the goodwill that has arisen by acquiring a partnership business, right? And goodwill is an intangible asset, and intangible assets is dealt with by International Accounting Standard 38, right? So this falls under IAS 38 intangible assets, and this is a purchased goodwill. We could say that because G Limited is acquiring a partnership business, which means that G Limited is essentially purchasing a partnership business, and in doing so, G Limited will also purchase the goodwill of that particular business, right? And that purchased goodwill should be recognized in the financial statements, but we have 2 different values. So one is 30,000 and the other one is 24,000. But remember that the 30,000 value is at the beginning of this year, which is 1st January 2020, and 24,000 is the value at the end of this year, which is 31st December 2020. And whenever we are preparing the financial statements, it has to be done at the ending date, which means that the goodwill value to be included should also be the ending value, which is 24,000. Okay, so this is the treatment for 1I. We can write it down. This falls under IAS 38, which deals with intangible assets. Okay, and the appropriate accounting treatment is that since this is a purchased goodwill, this should be recognized in the financial statements, right? So since this is a purchased goodwill, it needs to be recognized in the financial statements. And should be included at its value at 31st December 2020, and that value was 24,000. Okay, so this concludes item 1I. Now we can move towards item 1II. Let's have a look above. Again, this also deals with goodwill. An advertising campaign 2 years ago had boosted the sales, and the directors believe that the products are getting more popular and the company has a good reputation. So, goodwill of 50,000 and the associate revaluation reserve of 50,000 have been created and recorded. So we know that this goodwill was generated due to the products getting more popular and the company having a good reputation, right? Which means that this is internally generated goodwill. This has not been purchased from any other business. And whenever we are talking about internally generated goodwill, IAS 38, which again deals with intangible assets, states that these should not be recognized in the financial statements, right? So if the goodwill of 50,000 is not to be recognized in the financial statements, then the associated revaluation reserve of 50,000 should also not be created, right? So that is the appropriate accounting treatment. Let's write it down. Again, this deals with IAS 38, which is intangible assets. And this deals with internally generated goodwill, right? So since this is an internally generated goodwill, it should not be recognized in the financial statements. And since we are not recognizing any goodwill, which means that there should be no revaluation reserve surplus of 50,000. Let's write it down. Therefore, there is no revaluation surplus of 50,000. So this concludes item 1II. Now we can move towards item 2. Okay. Included in the property, plant and equipment is a specialized machine with a net book value of 32,400. This machine is used exclusively to produce a particular product whose production will be stopped 2 years later. And the fair value and the value in use of the specialized machine are 29,000 and 28,600 respectively. If this specialized machine is to be sold, a selling cost of 2,000 is expected to be incurred. So since this deals with the valuation of non-current assets, I'm assuming there might be an impairment loss, right? So I'm just going to write it right here. Impairment loss. An impairment loss arises when the carrying amount is greater than the recoverable amount. So this is just the difference of carrying amount and recoverable amount. Okay, in this case, the carrying amount is just going to be its net book value, which is 32,400, right? So I'm just going to write the value 32,400 minus, we need to subtract the recoverable amount. And the recoverable amount is just going to be the lower of fair value and the value in use. And we can see that the fair value amounted to 29,000, whereas the value in use amounted to 28,600. So obviously the lower one is 28,600, which is value in use. So the recoverable amount is going to have the value of 28,600. And this obviously gives rise to the impairment loss because we can clearly see that the carrying amount is greater than the recoverable amount, right? So impairment loss is going to be 32,400 minus 28,600, which results in the value of 3,800. So this is the correct treatment. We should treat the impairment loss of 3,800 since the carrying amount exceeds the recoverable amount, right? And the impairment of assets is dealt with by International Accounting Standards 36. So we are going to apply that. Let's write it down. Okay, we have International Accounting Standards 36, which deals with impairment of assets. And here, the carrying amount exceeds the recoverable amount, right? Let's write it down. Since the carrying amount exceeds the recoverable amount, impairment has occurred, right? And in this case, we already figured out the impairment loss of 3,800, so we should include that as well. And in this case, there is an impairment loss of 3,800. Alright, this concludes item 2 as well as the second part of this question. We can now move towards the third one. We now need to prepare the revised statement of financial position at 31st December 2020 using all the available information. Alright, so I'm just going to write down the heading, revised statement of financial position at 31st December 2020. Okay, so we are already given the draft statement of financial position, right? So I'm just going to copy around the headings from that and then figure out the amounts later. So the first section we have is the non-current assets, and it includes goodwill as well as property, plant and equipment. So let's write it down. So we have non-current assets that deals with goodwill and property, plant and equipment. Right, so this gives the total for non-current assets. Now we can move towards the current assets section. Let's have a look above. Right here we can see that the current assets includes inventory, trade receivables and cash equivalents. Let's copy these down. So that's inventory, trade receivables, and cash equivalents. Okay, and this gives the total for current assets, and now we can move towards figuring out the total assets. Okay, then we can move towards our capital and liabilities section. We can see that the first one is equity, which deals with ordinary share capital, revaluation reserve, and retained earnings. So let's copy these down as well. That's equity with ordinary shares with $1 each. The next one was revaluation reserve. And then we had retained earnings. And this gives the total for equity. Then we can move towards our liability section. And we can see here that non-current liabilities is of a bank loan from 2021 to 2025. Let's write it down. So our non-current liabilities, there's only one, so that's bank loan 2021 to 2025, and this gives the total for bank loan. Now we have the current liabilities. And we can see that the current liabilities includes trade payables. So let's write it down. That's trade payables. And this gives the total. And we can figure out the total for equity and liabilities. Now we can move towards figuring out each of the headings values. So we will definitely start with goodwill. Let's have a look above. So previously goodwill was valued at 80,000, but we know that we already dealt with goodwill in the first part. and we have already included its correct treatment as well right here. So for item 1, it was a purchased goodwill, and we figured out that the value should be recognized in the financial statements at 24,000, right? But in case of the second one, it was an internally generated goodwill which should not be included. So the only value that goodwill should be including is 24,000. Let's write it down in our statement of financial position. So that's 24,000. Now we can move towards property, plant, and equipment. Let's have a look above. So initially its value is 544,000, and we dealt with item 2, which concluded that there was an impairment loss of 3,800. So this impairment loss should be subtracted from the value for property, plant, and equipment. Let's do that. So that's 544,000 minus 3,800. Let's have a look at another information. So the third one deals with inventory. Then we have provision for doubtful debts. Then the bank loan repayment. Okay, so the only item relating to property, plant, and equipment is item 2, and we already adjusted it. So now we can figure out the total. That's going to be 544,000 minus 3,800, which results in the new value for property, plant, and equipment to be 540,200. Let's input this value in our statement of financial position. Okay, so that's 540,200. Now we can easily figure out the total for non-current assets, right? That is just going to be the sum of these two values, 24,000 plus 540,200, which results in 564,200. Okay, now we can move towards figuring out the value for inventory. We were given additional information regarding inventory right here. Inventory includes one product which had been accounted for at the selling price of 40,000, and the markup for this product is 25%. Alright, so markup of 25% just means that the selling price is going to be cost times 1 plus we are increasing the cost by 25%, which is the markup value. We can write it down as 0.25. Okay, and we know that inventory should be including the cost rather than the selling price, but we have been including the selling price of one product, which is 40,000. So we need to figure out its cost. That's going to be 40,000 equals to cost. And we can bring this 1 plus 0.25 to this side. So that's going to be 40,000 divided by 1.25. Now we can easily figure out the cost, which is 40,000 divided by 1.25, which results in 32,000. Now we can move towards correcting the value for inventory. So we can see that previously inventory was valued at 88,000, but we know that this includes the selling price of 40,000, which should not be included. So I'm just going to subtract the 40,000. And instead of the selling price of 40,000, we should have been including the cost of 32,000. So I'm just going to add the 32,000 back. So that's going to be plus 32,000. And this gives the new inventory value to be 80,000. Let's include this in our statement of financial position. For inventory, that's 80,000. Alright, now we have trade receivables. And we were given information regarding providing doubtful debts, which obviously deals with our trade receivables, right? So we are told that G Limited started providing for doubtful debts in 2020, and a provision of 4% had been made. A credit customer owing 15,000 had been declared bankrupt, and the whole amount had to be written off. Okay, so what this information means is that we provided a provision for doubtful debts at 4% without subtracting the bad debt of 15,000. So this needs to be adjusted, right? So above we can see that the trade receivables amounted to 187,200, but this is the value after deducting 4% of provision for doubtful debts, right? Which means that this is only 96% of the original trade receivables. So let's figure out the original trade receivables. 96% is 187,200, so that's just times 0.96 equals to 187,200, and this gives the original trade receivables without applying any provision for doubtful debts to be 187,200 divided by 0.96, which results in the value of 195,000. Okay, and we know that before applying any provision for doubtful debts, we need to subtract all of our bad debt, right? So we need to subtract the bad debt given below. We were told that customer owing 15,000 had been declared bankrupt. So this is a bad debt. Let's subtract this from our trade receivables. So that's just 195,000 minus 15,000, which results in our trade receivables after deducting the bad debt to have the value of 180,000. Now this is the amount at which we need to be charging our provision for doubtful debts, right? So let's do that. We know that we should be charging 4% provision for doubtful debts, which means that only 96% of this amount should be included in our statement of financial position, right? So let's figure out 96% of 180,000. That's 180,000 times 0.96, which gives our new trade receivables value to be included in the statement of financial position to be 172,800. Let's record this. Okay, trade receivables at 172,800. All right, now we have cash and cash equivalents. Let's have a look above. So we're only given information regarding bank loan. There is no information to be adjusted towards our cash and cash equivalents. So we can just substitute this value. That's 34,800. Let's write it down. Now we can easily figure out the total for current assets, which is the sum of these three values. 80,000 plus 172,800 plus 34,800, which results in the total current assets to be 287,600. Now we can figure out the total assets. That is just the sum of non-current assets and current assets. So that's 564,200 plus 287,600, which results in total assets to be 851,800. Okay, now we move towards the equity section. We have our ordinary shares, and we know that there were no additional information regarding ordinary shares. So we can just substitute the original draft value of 500,000. Let's write it down. That's 500,000. Okay, then we have revaluation reserve, and we actually added 50,000 to the revaluation reserve for the internally generated goodwill, right? And we also concluded that this value should not have been included in the revaluation reserve. So I'm just going to subtract the 50,000 that we added to the revaluation reserve for increment in goodwill. So previously it was 85,000, so I'm just going to subtract the 50,000, which results in the new revaluation reserve value to be 35,000. Let's include this value in our statement of financial position. And the third one is retained earnings. So let's have a look above. Okay, so previously retained earnings had the value of 153,000. I'm going to start with this value. And the first thing that we need to adjust is goodwill right here, because previously we adjusted it at the value of 30,000, but now we have concluded that we should only be including 24,000, which means that our retained earnings is overstated by this difference. So that's 30,000 minus 24,000, which results in 6,000, right? So this 6,000 should be deducted from our retained earnings because it was overstated. So I'm just going to subtract the 6,000. All right, then the second one was associated with revaluation reserve. We already adjusted it. It does not affect retained earnings at all. Now, for this one, we figured out our impairment loss, which should definitely be subtracted from retained earnings because retained earnings includes the profit for the year, and we actually needed to subtract this from profit for the year, but since we do not have that, we can subtract this or adjust it to our retained earnings. So that's going to be minus 3,800. All right, then the third one is the inventory which we included at the selling price, which means that this inventory actually included the unrealized profit as well, right? And this unrealized profit should be deducted from retained earnings because, like I said before, retained earnings includes the profit for the year. And the value for this inventory unrealized profit is going to be the difference between its selling price and the cost price. We know that the selling price was 40,000 and we figured out the cost price to be 32,000. So the difference between these two is 40,000 minus 32,000, which results in 8,000. So we can see that the unrealized profit was 8,000, which needs to be subtracted. So that's minus 8,000. All right, then we were told that there was a bad debt of 15,000. So bad debt definitely reduces our profit, right? Because we subtract the irrecoverable debt or bad debt while figuring out our profit for the year. And again, we need to adjust this. So we will be subtracting 15,000 from our retained earnings. That's minus 15,000. And we also had our provision for doubtful debts, right? So we need to compare the previous provision for doubtful debts and the current provision for doubtful debts to see whether there was an increment or decrement. Let's have a look above. So, okay, for previous provision for doubtful debts, we can subtract these two amounts, right? Because the difference is just going to be the provision for doubtful debts. So that's going to be 195,000 minus 187,200, which is also in the previous provision for doubtful debts to have the value of 7,800. And currently 4% of 180,000 is to be the provision for doubtful debts, right? So let's figure it out. That's going to be 180,000 times 4%, which we can write down as 0.04, which gives the new provision for doubtful debts to have the value of 7,200. So we can see that the actual value should have been 7,200, but previously we had included 7,800, which means that our provision for doubtful debts was overstated, right? And the overstatement value is just the difference. So that's 7,800 minus 7,200, which gives 600, right? So this was overstated. So we definitely need to subtract this, right? So if we are to subtract 600, and we know that the provision for doubtful debts should always be subtracted in order to figure out the profit. So that's two negatives, which results in a positive 600, which means that we need to add this 600 to our profit, and profit is added to the retained earnings. So we just have to add the 600 to our retained earnings. That's plus 600. This concludes everything. So now we can figure out the total for retained earnings. That's going to be 153,000 minus 6,000 minus 3,800 minus 8,000 minus 15,000 plus 600, which results in the value of 120,800. Let's include this in our statement of financial position right here. So that's 120,800. Now we can easily figure out the total for equity. That is just the sum of these three amounts, 500,000 plus 35,000 plus 120,800, which results in the total equity to be 655,800. Okay, now we can move towards the non-current liabilities of bank loan, and we were given additional information regarding bank loan. Right here, 1/5 of the bank loan will be repaid in 2021, which means that this will be repaid within a year. So this automatically now becomes the current liability. So let's figure out the 1/5 of bank loan. We can see that previously it had the value of 100,000. So 1/5 will now be transferred to our current liabilities. That's going to be 100,000 times 1/5, which results in the current liability to have the value of 20,000. So if 20,000 is being transferred to current liability, this value should be deducted from the non-current liabilities, right? So previously it was 100,000, so we need to subtract 20,000, which gives the new bank loan to 80,000. Let's include this. That's 80,000. But we also know that we transferred 20,000 to the current liabilities, which means that current liabilities will now include the loan payable as well. And this amounted to 20,000. Okay, so the only value left is the trade payables. Let's have a look above. We know that there were no information given regarding trade payables, so we can just substitute this value of 96,000. Let's write it down. That's 96,000 for trade payables. So now we can figure out the total for current liabilities. That's 96,000 plus 20,000, which gives 116,000. Okay, now we can easily figure out the total equity and liabilities as well. And this will be the sum of equity, non-current liabilities, and current liabilities. That's 655,800 plus 80,000 plus 116,000, which results in the total equity and liabilities to have the value of 851,800. And we can see that the total assets value, 851,800, is same to the total equity and liabilities value, which means that our statement of financial position is correct. So this concludes the third part of this question. Now we can move towards the fourth one. Okay, we were given workings. So instead of scribbling all over the question paper like I did, you guys should be showing all of your workings in this particular box. Now for additional information. A director of G Limited says whether the financial statements show a true and fair view does not really matter to the company. We need to comment on whether or not the director's statement is correct. Okay, so we obviously know that financial statements should show a true and fair view, and it does really matter to the company. because a true and fair view really enhances the credibility of the financial statements. Let's write it down. A true and fair view enhances the credibility of the financial statements. And we also know that if the financial statements does not show a true and fair view, then the qualified audit report will be received, which basically means that the auditor will figure out that the statements does not show a true and fair view, which means that those financial statements cannot be published. Let's write it down. If the financial statements do not show a true and fair view, then a qualified audit report will be received. And if that's the case, then we can say that the financial statements showing a true and fair view really matters to the company, which means that the director's statement is incorrect. Let's write down that clearly. So the decision is that the director's statement is incorrect. Alright, this concludes the fourth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.